Dividends and return of capital. Let's review corporate finance at its core. The purpose is to maximize the value of a business through planning and implementing management resources while balancing risk and profitability. In the earlier chapters of this course, we looked at capital investments and capital financing of those investments. And now we turn to looking at dividends and return of capital and the decision-making process that managers of businesses go through when they decide if they will return money back to investors and why. At the end of the day, managers of corporations have to decide if they want to distribute the earnings back to shareholders in the form of a dividend or a share buyback, versus retain that excess capital and use it for future investments, either into existing businesses or into new projects or acquisitions to grow the company. And in order for them to make this decision, it really boils down to a very simple principle, which is, can I do better by reinvesting the money than the investors expect me to do? And if I can't do as well as they want me to do, I should give the money back. If I can do better, I should reinvest it. So in order to figure out how they make that decision, let's return to some concepts from earlier in the course. We looked at internal rate of return. Here's the cash flow profile of an investment, and we can see that the internal rate of return of making it is 22%. That may seem quite good, but in order to properly evaluate it, we have to compare that return to the firm's weighted average cost of capital, which is the rate of return investors expect to generate. So in this hypothetical situation, this firm has a WACC of 28%. So when we compare the two, we look at the internal rate of return of the project, 22%, the cost of capital, 28%, and then we are led to the conclusion that we should return capital to shareholders by either paying a dividend or repurchasing shares. Managers in corporate finance will typically look at two main balance sheet items when trying to decide if they should return capital. They will look at the company's cash balance and cash that's available for investing. They'll also look at the retained earnings of the business as well, although cash ultimately is more important than retained earnings since it's actually cash that's going to be returned to shareholders. The managers will have to look at future investments that they've already committed to and then decide if there's any excess cash available over and above those investments or operating expenses that they've already committed to fund. But assuming there is excess cash or excess retained earnings, then they'll follow the decision-making tree, where they will look at the internal rate of return of the investment and compare it to the WACC. And if it's more or less, then they decide what to do. So as a recap, if the internal rate of return is less than WACC, they have two choices. They can repurchase shares, which puts money back into the hands of the shareholders and takes it off the company's balance sheet. Or they can pay a dividend. If, however, we're on the other side of this decision tree, then it means there's a high enough rate of return that we should invest in that project. And the cash that's on the balance sheet gets used to fund the project. Let's take a look at dividends versus share buybacks. Dividends can be either one-time special payments or ongoing regular payments that are made to shareholders. Each shareholder is entitled to a proportional share of the dividend. The main reason to pay a dividend is that it contributes to the yield on a stock. The yield is the percentage relative to the share price that an investor receives on an annual basis. If a company pays a dividend, there is no impact to the number of shares that it has outstanding and no impact to the earnings per share of the business. Let's compare that to a share buyback or repurchase. A share buyback reduces the number of shares that are outstanding. As the name implies, the company repurchases from investors shares that used to exist and then retires them. This results in an increase in earnings per share. If earnings stay the same but the number of shares outstanding is reduced, then the earnings per share must go up. So for this reason, share buybacks can be very popular among managers of companies who want to increase their earnings per share. It's impossible to say if one is absolutely better than the other. It's just that they have pros and cons and are different mechanisms for returning capital to shareholders. It's this decision at the end of the day that completes the corporate finance loop, where the company has now gone through the process of looking at capital investments, financing them, and then ultimately deciding when to return capital to investors.